Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today I thought I'd talk about something that some observers of this series might not be aware of, and that is that some traders never use a limit order when attempting to buy a stock at a lower price. Instead, they may use one of the strategies that's discussed right here in this series, selling a put. So we're going to do a comparison of a limit order versus selling a put. What are the pros and the cons? And before we're done today, we're going to be planning and placing a trade using a new short put order to try to buy a stock at a lower price. Now, before we get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names, as always. Hello there, Victor and Paul. Unexpected good luck. Debbie, Lawrence, Cecil, Mark, Jack, Eva, Mighty Mouse, and everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions here in these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but be aware that you're invited to join us here in this live discussion. This is a Monday webcast series, and we kick things off promptly at 2 Eastern Time each Monday. I also want to let everybody know that my very good friend Barb Armstrong is hanging out in the live stream chat right now. She's going to keep an eye out for any questions that come in that I can't get to during the flow of the presentation. Barb will just be there to pick up my slack. Thanks for having my back there, Barb. Barb and I would also like to issue an invitation to follow us on social media. You can follow me and Barb on X. Find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. You can also follow us on LinkedIn. Barb, you might have to correct me on this because I know that Barb, I've only been on LinkedIn for a couple of months. Barb, I think it's been a couple of weeks now. But you can follow me there at well, no, don't go there. Go to linkedin.com/in/Cameron May CS or linkedin.com/in/Barb Armstrong CS. Let me know if I got that URL correct, Barb. But let's dive into this. A lot ahead of us. I think this is going to be a very good discussion. Why do some traders never use limit orders to try to buy stock? Oh, that's a good question. In any case, in any approach to investing or trading, there are risks involved, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. And finally, any investment decision you make in your self-directed account is solely your responsibility. All right, so here's what we're going to be spending our 45 minutes together today doing. Number one, we're going to look at our current example trades in our paper money portfolio. We have a good number of those going on. I want to give some context regarding performance. Then we're also going to be making a change to at least one of those positions. Then we're going to have a look at what's going on with the markets. We won't spend much time on that because markets just continue to charge higher. In any case, that'll leave us the bulk of our time for a discussion of this different approach to trying to buy stocks at lower levels. Could use a limit order. Might also choose to sell a put. There are pros and cons to both of those approaches. So we'll discuss those, and we're going to place an example trade today. Eva says, Cam, you do use limit orders when short puts aren't that great. And there can be that situation, right, Eva? So yeah, I want to talk about the limitations of this strategy because I'll admit, when we first start talking about this, it might sound like, oh, this thing is all good. No, with each strategy, each approach to the management of a self-directed portfolio, there are pros and cons to each decision. So let's be fair about it. In any case, let's go right to the Thinkorswim desktop platform. Here we have 7 current positions. And one thing that I wanted to call out regarding, I said we want to talk about the context of performance right now. Look at the performance of our 7 stocks right now. Isn't the purpose here to make money? And if you look over here at the profit or loss since we opened these positions, we're down $2,900. This isn't going very well. Well, sometimes that's just the way it goes. However, with Thinkorswim, as with lots of platforms, you need to be careful, be cautious about looking at the bottom line current performance of existing portfolio positions and think that's just the way it's going. As in reality, on these 7 securities, there's more history than is reflected in just the current position. Yes, we're down $2,900 on the current construction of the portfolio, but overall on these 7, we actually have recent a net profit exceeding over $13,000. So one thing that's not reflected here are realized gains, and we have over $4,000 of realized gains from options that have previously been sold, and we've either expired or closed out those options. Plus, there's some realized gain on stock, over $12,000 of realized gain on stock. So I just wanted to note that when we're looking at this bottom line, it's just for current positions. Okay, Mark says realized gains are the best gains. They're the real gains, right, Mark? That we call paper gains. That's another word for unrealized gains, even when we're not on paper money, because it's a gain on paper and it can vanish because we haven't banked it yet, right? All right, but let's get through our current positions. Apple, I think, is going to be the only one we make a change to today. So here's what's going on with Apple. Here's the history, and here's why. Here's an example of why, Apple says we're only $200 up, but that does not include a realized gain of $290. Was it $290? No, $270 here. Sold the 16th of January, 265 puts for an assignment. Those were assigned, but that does become a realized gain on those puts. We had previously sold two December 19th, 265 puts. Those each expired for $277 profit each. So about $550-ish of realized gain there. But we did get assigned at 265. Our break even on this is at 259.53, and you can see the stock is starting to rise. And we had a note here. Consider selling covered calls if assigned, and we have been assigned. This is where the trader might decide for themselves, well, do I want to keep the shares that have been assigned to me? And if I do I want to start selling covered calls on those? And let's say that our trader here assigned at 265, but seeing the shares starting to rally from a short-term dip there, maybe if their outlook is bullish, well, keeping shares might be beneficial, and maybe they could sell some calls for income. That's what we're going to be doing here. So with the shares trading around 267, I don't know if we could get away with, maybe a trader might look at selling up here at 287.5 or 290. There's probably not much premium unless we go significantly further out in time. And I think for most of our trades today, we're still going to be sticking with that February expiration. Maybe down here at around I don't know, maybe 277.5. Let's say, or 275. Let's go for 275 maybe. That's about right there. You can see how that's been a previous resistance. Let me extend this out. Let's extend that to left. Just shoot it out there to the left. So I wonder what we can get for a 275 strike for that February expiration, February 20th expiration. Let's go to the trade tab. There's the 20th of February, the 275 strike for Apple. About $2.17, 18 cents maybe, somewhere between that bid price and that ask price. Now with Apple, we just have 100 shares. So let's sell one contract. Let's look at the 275. I'm going to click on that bid price, just sell one contract. Looks like our natural and mid are only about a penny or two apart. Let's just leave it at the natural rather than trying to squeeze an extra penny out, try to move it to the bid. Looks like prices are moving around a little bit. Let's just leave that, lock that as our limit, and click confirm and send. Let's try to sell that one Apple 20th of February 275 call for a 220 credit. Subtract the commission from that, that would leave us a minimum acceptable credit according to this limit order of 219.35. Let's send this order off and see if we can get that filled. And we did. Sold that at 220. All right, cool. So from here, the investor or the trader's perspective, their preference might be for the stock to continue to climb, which helps out the ownership of the stock. But if we can just be below 275 by that expiration of February 20th, maybe that contract will just expire worthless, Mark, and maybe we can have a realized gain on that premium. There we go. So that's trade number one. Let's look at our other positions. With these, like I said, I don't think we're going to be making any changes. So as we look at AbbVie, so this one, we originally bought the stock right here for $227.18, sold some calls. Those expired for a profit. Sold some more calls. Those expired for a profit. Actually did it in the opposite order. We sold these calls first, then these ones. That's lowered our break even down here to 223.42. And you can see we're just above that break even. That's a pretty, not a terribly encouraging looking shooting star candle. A shooting star is when you have a little tiny body with a tall wick sticking out the top of the candle, meaning there's maybe an intraday rally that failed, especially if that happens toward the top of an upward move. And that's kind of where this sits. We're still above break even. There is an earnings announcement around the corner. Mark's saying, I think we should sell this. We could just exit. If we can exit for 224.57, we make $1-ish. I think I'm going to hang on to this. We're going to see if that turns out to be the right decision. We do have an earnings announcement that we'll be talking about next week, for better or for worse. So I'm going to leave that on there. Now, another thing a trader might do is maybe scale back a position if they're a little bit concerned about what the future might bring. I'm just going to leave this, though. Let's go to Amazon. With Amazon, we've sold some puts. We sold the 235 put. It's a bullish strategy where we prefer to be above 235 unless the trader's objective here really is to wind up owning the shares. The stock right now is at 244-ish, but the trade itself is actually about $1 underwater, not too far from break even. So here's what's going on with Amazon. Let me see if I can type. There's Amazon. Here's the history. This is why I'm saying, yeah, we're $200 underwater on Amazon right now, but that's just the current position. So here's what's happened before this. We sold some puts for $370, closed one of those contracts for a $303 profit, so that's $303 that was realized, closed the other one for a $365 profit. So there's $300 or $670 of profits that are realized. It's not reflected on that monitor tab. It's not that it's not doing its job. The monitor tab is doing exactly its job. This is a reflection of current positions. Closed contracts are previous positions. You can go to the account statement to track those. Anyway, but then we sold some new puts. Those are the 2nd of February, the February 20th, pardon me, not the 2nd of February, sold 2 February 20th puts at the 235 strike for $560 each. That's right here. And you can see we're starting to get a rally above that level. There is an earnings announcement. We're going to ride through that earnings if we happen to sell off. And if we get assigned, we might consider selling calls. But I'm going to leave that one alone. Next up is our Google position, our Alphabet position. It was a hugely profitable position. It might make another small profit. So on this one, we previously purchased shares for $199.15, and they just went up and up and up and up. Started selling calls against those shares. One of those just expired for a profit. The next one was assigned. So we wound up selling the shares that we bought for $199.15, sold those for, what was our strike? $325. So we sold those for $325. That's a $12,585 realized profit, commissions set aside. So that's done. That was a done deal. So here's the new trade. We bought another 100 shares for $333.82, I think that says. It's just kind of squished in there. Maybe if we expand this out a little bit. Nah. Let's just zoom in. There we go. Bought 100 shares for $333.87. Sold a call agreeing to sell those shares for $340. If that contract is assigned, we'd make a small profit, $5.13 on the shares. We also collected a premium of $305, so in position to make a little over $8 if assigned. And assignment is looking highly probable because these contracts expire today. It's Monday. These are the new Monday expirations that were just introduced last week. So we talked about this brand new type of option. It was only introduced for the Mag 7 stocks and a couple of others. So it's a very rare type of option. In any case, this is looking like assignment is very likely, not guaranteed. If we peel back, we're back down below 340, maybe it doesn't get assigned. But I think I'm just going to let this one go. That one's in good shape, looking like a likely profit. Next up is our Microsoft position where we sold a put. This is the one that's just not performing. It just refuses to cooperate. So if we go to Microsoft, we don't even have a history with this one to bail us out. It's just a bad trade. So here we saw, looked like Microsoft had been holding above a support level right there at 490. So we sold a put. I believe it, well, we sold the, we sold it right there on that date. Sold the 21st of January of 2028. These contracts still have 2 years left on them. Sold those contracts for $23. We were just hoping to get some kind of a rally, bring down the value of those contracts so we could buy out less expensively. And it didn't happen. Broke support. That old support acted as a pretty good price ceiling for a while. And then we've just sold off again. Earnings went against us, and on it goes. So here's where a trader might have a very serious question to address. There are 2 years left on this trade. Could we just hang in there, hopefully let time decay kick in, hopefully we can get a rally sometime in the next couple of years, get us back up away from our strike and maybe close that out at a profit? Well, if we wait for that, sometimes that doesn't happen. If the stock continues to fall, that might wind up costing us more and more and more money to close this put out. So we're about 1,300 bucks underwater right now. That's not anywhere near how much we could actually wind up losing. Look at this. We sold this for 23. It's worth 38 right now. Mark says it's interesting that Microsoft beat earnings, but still dropped hard. Yep, there can be the good news is bad news. It can also be disappointment in the guidance of an earnings announcement. But what should we do? Now, obviously, a technical trader may look to their charts to try to get some gauge. Well, is there any hope for this position, at least in the short term? And one thing that I thought we could discuss is there's a previous resistance that has acted as a support on the strength of this gap, maybe. And you can see that yesterday's low was right down to that previous resistance. Shall we hold on to this and consider closing out here? I shouldn't say selling. That's a misstatement. Let me edit this, because we're not selling to close, we're closing. You have to buy this one to close. Let's maybe consider closing if support breaks. What do you think? Or we have lots of time on this. Could we be even more patient and maybe we think that this next level, failing support here, maybe the next level support could hold. That's still above our strike price. It's still an out of money put. It's just getting closer and closer at the money, getting closer and closer to getting in the money, while there's still plenty of a time for it to go deeply in the money. Glenn says, my personal rule is never to trade over earnings, better safe than sorry. Some traders have that approach. However, with longer term trades like this, trading over earnings is just kind of part of the deal. It's essentially unavoidable unless we're trading on something that doesn't have earnings, right? Yeah, and stocks that trade, equities that trade on the U.S. exchanges report their earnings. So how about, what should we do? What do you think? 2 levels of support max, Paul says. Paul's voting for 2. Let's say 1, if we say just breaking this first one, we want to get out. 2, if we want to be patient, wait for even that second level of support. What do you think? RB Tech Trader says, could you roll to a lower strike? We could. Now, what I want to say about that is because rolling, boy, that's one of those, I get a little bit heated under the collar because of the misrepresentation that rolling gets from so many hucksters out there trying to promote it as a cure-all. It's not. It's not. Rolling a trade simply means, well, let's close out this one and let's replace it with another one and hope that one goes better than the first one did. I think that's a perfectly good description of a roll order. Now, there are times when we're rolling because the trade has gone so well. Now, there are other times when we're rolling because the trade has gone so poorly and we've got our fingers crossed and we're just hoping that this one does better. If we roll into another short put, that's still a bullish trade. And if that one fails, it just adds loss to loss. So yes, could it roll? Yep. Could we extend the timeline for this trade to maybe pull out of its tailspin? Maybe if we could find something that's even longer than the 28th of January pardon me, 21st of January 2028. But rolling's not a fix. Doesn't fix anything. Rolling, let me state it plainly. Rolling fixes nothing. I don't like to make flat out statements very often unless I'm very confident in that I'm saying exactly the right thing. Yeah, roll doesn't fix anything. All it does is it closes one trade and puts on another trade. Maybe it's an extension of a profitable string of trades, or maybe it's an extension of an unprofitable string of trades. All right, so, but it's a really good question. I'm glad you asked it. So this one, all right, what are our votes? Oh, Paul, you're saying this is at the second level now. Yeah, because it already broke one previous support. I get what you're saying. Should we just say, yeah, let's say not consider closing if support breaks. Let's make this more definitive. Close if support breaks, period. There we go. So we'll wait for that, see if it does. It looks like it probably will happen. We'll talk about that next week, see if it looks like we've definitively broken that support. So let's go back here. We have two more to go through. NVIDIA, another covered call, sold to 195 for the 20th of February. Stock is only about 190, so it doesn't look likely that will be called at the moment. But here's NVIDIA. This one does have a profitable history of contracts previously traded. And we've most recently sold into the 20th of February 195 call. That's right here. And it looks like our stock came up yesterday, not yesterday, Friday, and just hit a high, 194.49, and then we've kind of peeled back from that. Break even is way down here. This trade seems to be doing just fine. I'm going to let that one work. And finally, we have Visa. This is another one, I think, where we have an earnings announcement, if I'm correct. Let's look right around the corner. Yeah, there we go. So we made the decision last time to hold because it was holding this support. And yeah, it's kind of running up from that support. That's interesting. Oh, actually, we have passed that earnings announcement. So this is interesting. So if we're past that earnings announcement, and if that was the reason why we chose not to sell a call, we didn't want to put a cap on the shares, and possibly for good reason, because we're starting to move up again. Maybe it's time to start selling calls. Here's what I've got to observe, though. Our break even on this trade is way up here at 352 and change. If we sell a contract below that level, what we're doing is getting ourselves into a trade where our best case outcome is to lose money. Well, that sounds terrible, but actually we're already losing money. Another way that I might say that is our best case outcome is that we'll lose less money than we're losing right now. But yeah, if we sell a call below, let's say, a 352.5 strike, well, actually, whatever the premium is, maybe it lowers that to, let's say, 350 or 351. Maybe we can get that break even down a little bit lower. But most likely, the trade's going to be below break even. How about this one? I'm going to let it go for one more week because I want to give that some deeper discussion. I don't want to take the time to do it today. Let's just leave that as a long stock position, see if we can get some recovery, and we'll talk about selling a call on that next week. So that brings us through our current positions. Let's see what's going on. Eric says, give it some time to breathe. Yeah, give it some room to breathe. Exactly. We're giving it both by not selling a call. Now, obviously, because we didn't sell a call, we also don't have the income, so that if the stock pulls back, we don't have anything to slightly compensate us for, a capital appreciation loss. But that's okay. We'll talk about that more next week. So for now, let's see what's going on with the markets. Are they still as strong as they were 45 minutes ago? Yup. Look at that. Trading just a fraction of a percent. This could be our strongest all-time close on the S&P 500. It could be a record. If we just closed right where we are right now, that would be a record high close. That's how strong the markets are. So that's very good for covered call owners and for short put sellers for the most part. It's not a guarantee of success with those strategies, but a broadly diversified group of those sorts of trades probably doing just fine over the last at least 10 months or so. So we're just going to continue along that trajectory. Let's continue. Bruce says, what does a K-shaped recovery mean? it basically means that that the participation in the recovery diverges. Like, it's basically the idea of the wealthy getting wealthier because they own a bunch of assets as let's say real estate and things are going higher. But those that don't own those assets due to the impact of inflation, they're not participating in the recovery. So if you think, here's where we were, some are doing well, some not doing so well, there's your K-shape. All right. So let's see, what else do we have? Let's go look at a new position. So let's add, I'm going to be doing a short put, as I mentioned, and I'm going to be doing that today on PG, but I want to propose this using this idea that some traders just don't use limit orders when they're looking to buy a stock at a lower price. So here's the theoretical scenario with Procter & Gamble. PG has had a rough, unlike so many other companies, PG's had a rough run over the last year, just making lower highs and lower lows, lower highs and lower lows. But just very recently, that pattern seems to have broken away in a new direction, starting to stair step higher. So for some traders out there, does anybody else feel like sometimes a stock just feels really overweighted? All these stocks that are right up near all-time highs? Yes, at times, traders will turn their attention to sort of neglected areas of the marketplace to see if there's something else that just has new signs of strength instead of super hot signs of strength. So let's say that our trader here is viewing Procter & Gamble through that lens. And I see that it's been running up and pulling back and running up and pulling back. It's broken its trend line. Maybe this is starting to work its way up to previous highs. And so our trader is thinking, oh, maybe I'll just buy the stock. However, in the short term, there could be a timing issue, because if we run up and then pull back, and then run up and then pull back, maybe now we've already run up a little bit. They might be waiting for that pullback. So maybe they want to buy if they can get in, let's say for $150. About halfway, that would require a pullback about half the distance of this run up. So what could we do here? Could put in a limit order. Let's do it. Here's how that limit order might be placed. Let's go to our trade tab. Oh, and by the way, let me put in one additional requirement. Let me zoom back out again, just a little bit. So there's our 150. Let's say that our trader wants to try to grab the shares in the near term, because if the price just continues to strengthen, maybe they missed it and they'll say, never mind. So maybe sometime before, let's say, the 20th of February, for convenience purposes. Fib Zone says, is this the time you'd place a covered call? Some might do that. Sometimes we talk about covered calls in this series. Today, we're going to do short puts, right? But let's put in an order to buy the stock if we can get it for $150 in the next couple of weeks or before the 20th of February. So I'm going to actually set this order to either fill or expire on the 20th of February. This is the way that we might do that. Let's go to our trade tab, click on the ask price. Let's buy 100 shares of PG, but not at the current price, only instead if the price happens to go down to 150. That's a limit order. Let's make that a good till canceled order. Kind of begs the question, well, when do we want to cancel it? We can do that using our little gear icon right here. And let's cancel on February 20th. How about we just put this right at the end of the day? That would be 2:30 local time, 14:30 in military time. There we go. So let's click save. If I click confirm and send, we're buying 100 shares of PG at a 150 limit, good till canceled, and this will be canceled on February 20th if it hasn't filled. Okay. There we go. That's the idea. I'm not actually going to send this order off. I wanted to build it though, so that we can start thinking about how this would work. So here's trader A, and they're thinking, I just want to buy the stock if it can fall down to 150. Well, believe it or not, by putting in a different type of order, that same trader might actually collect a premium or a payment to buy those shares at 150. And that is by selling a put. Let's stay here with the 20th of February, and instead of putting in a limit order, let's do this. Let's go to the put side of things, and it looks like that's around $1 to $1.09. What if we click on this bid price? So this is going to be our example trade. we're going to sell a put. And in this case, we're going to sell the 20th of February. Let me move my cursor so you can see what I'm typing there. 20th of February, 150 put. That looks like we might be able to get, $1 to $1.04. Let's just say we get $1. Let's say we don't get the best fill ever, and we sell this put for $1. What's actually going on here? Mark says it's kind of like we're getting paid to buy the shares. Yeah. What we're doing here is instead of putting in an order to buy the shares at 150, we're getting into a contract with another trader where we agree to buy their shares for 150 should they choose to sell those shares to us. Now, it is up to them, but there are specific circumstances where it makes it highly likely that they will sell those shares. But that's the deal. We're collecting $1 per share. Now, on 100 shares, that's $100 that's being paid to this portfolio in exchange for agreeing to buy the shares for the price that we wanted to buy them for in the first place within the time frame that we wanted to buy those shares. This is sounding like, is there anything wrong with this approach, Cameron? Well, there are potential disadvantages. Yes, we need to make sure that we're aware of that. Noodlebrain says, is the premium enough? Some people aim for 0.5% per week. Yep, people can have their own preferences for what's adequate and what's not. What I will say here is, well, at this moment, it's get paid $0 or get paid $1. That's the comparison we're making at the moment. Limit order versus selling a put. Limit order doesn't pay anything. Selling a put pays $1. So, the scale's just tilted for selling the put. Doesn't mean they're going to stay there though. Because I want to talk through how, let's do trader A, trader B kind of comparison. And let's just do it on one contract. So it's one contract versus a limit order for 100 shares of stock. So let's go back here. Here's where the stock is right now. And let's play the what if game. Let's do a little thought experiment. See if we can envision the future. How this, which one of these works out to be the better idea. Let's say the stock doesn't come up, it doesn't go down like either of our traders is hoping for, and instead, come February 20th, the stock has gone up and it's just higher than it is right now. Is that a possible outcome? Of course it is. So if our shares are up here at $156, $157, $158, and we have an order to buy if we can for $150, does that order ever fill? Nope. We've been sitting there from February 2nd to February 20th. 18 calendar days have gone by. We never owned those shares. For the whole 18 calendar days, though, we probably left that cash alone in case we had to buy those shares, right? So we had money tied up with nothing to show for it at the end of 18 days. Not a great 18 days for our trader. Trader A, not so good. Trader B, stock goes up to 158. Someone has the right to sell them shares for $150, but those shares are worth $157, $158. Are they going to do it? No. Very rare exceptions. They are not going to sell those shares to our trader B for $150. So trader B doesn't wind up with the shares either. You know what they do wind up with though? They got $100 in their pocket to show for it. So their efforts were not in vain. And heck, if they, anyway, if this happened occasionally, could add up over time, right? All right, so that is a check for trader B. Selling the put was the better trade in this scenario. And the same would hold true if the stock were to go sideways or if it were to go down. In any case, if the stock is above our 150 level by expiration, the nod goes to selling the put. All right. But what if the stock comes on down, goes down through 150, and now we're down here at 140, 147 at expiration. What happens here? Let's talk about both scenarios. Trader A had an order in to buy the shares at 150. As the shares came down below 150, the system says, oh, I can get you those shares for 150 now, and it fills the order. It might not be for exactly 150 though. 150 is just the maximum that trader will have paid. But yeah, they wind up buying the shares. Let's say they do buy the shares at 150. All right, so now come February 20th, they bought the shares at 150. They're only worth 147. Those shares they own the shares. Great, that's what they wanted to do. They're $3 less than the price that we paid for them. That's not so great, but at least it's not $6 below what they would have been had we just purchased the shares on day one. So Trader A is probably feeling okay. All right, a little bit underwater, but I'm not as far underwater as I might have been. I got the shares at the price I wanted. Cool. What about Trader B? Shares come down. They're below 150, and as we hit February 20th expiration, someone has the right to sell shares to us for 150. They're only worth 147. Are they going to do it? Yeah, they're going to do it. Very rare exceptions. They're going to exercise their right to assign that contract, sell the shares to us for 150. So we bought the shares at 150. Those shares are now also, they're worth 147. We're $3 underwater, but we have $1 of realized gain from the premium that we collected to help us feel even a little bit better, more better, better about having purchased the shares at 150. So yeah, underwater, but we already have a premium. So we wind up with the shares plus the premium. So in this scenario, it still looks like Trader B wins in all scenarios. Nope, it's not true. Because you might say, well, so if the stock goes up, Trader B comes out ahead. If the stock goes down, Trader B comes out ahead. Trader A is always left in the dust. Not always. Nope. Here's where it could be a big difference. What if, let me just remove this drawing, and let's say we get a big old red gap down candle. Let's say it goes like this. So we're coming down and down and down, and then we gap down here. Let me edit the properties of the candle here, our hypothetical candle. Boom. Gap down. Let's actually pull this down a little bit further, just to make it a little bit more exaggerated. Let's say they're a really nasty day, and the stock gaps down overnight down to 146. And then we hit expiration while the stock is down here at 143. I don't know. Say it gaps down here and then it goes like that. Well, when we drop below 150, our limit order is triggered. Ooh, we can get you those shares for 150 or less. In this case, we might buy for around 146. Bought those shares at 146. That's Trader A, got a steep discount on the shares. Trader B, who's in the contract, is required to pay 150 for their shares. Required to. It's not the maximum, as with a limit order. It's the required purchase price. The Trader B buys the shares for 150. Those are only worth 143 now. They're $7 underwater, whereas Trader A with their limit order is only $3 underwater. So on a strong gap down, that's where the limit order might win the day here, right? So it's not always true that selling a put is the better entry when trying to buy at a lower price. I can say probably with a fairly high degree of confidence, in most cases, it might be the superior approach, but not always. There can be big advantages to trading with limit orders. Now, there are some other limitations here. Other limitations before we go sell our put that we need to be aware of, and we're talking specifically about selling puts versus a limit order. The limitations of selling put, number one, is, well, let me just delete this for a second. We have limited choices regarding the number of shares. You know, maybe our trader only wanted to buy 47 shares, but we can't do that with an option. The standard option is for the potential purchase or sale of 100 shares of stock. So we trade in round lots. That's not a requirement for our would-be stock trader who's using a limit order. The second limitation is the available strike prices. Maybe our trader wanted to buy at $151.52. Can't do that with a short put. we have to kind of round off to whatever strike prices are available. So share quantity, not highly customizable. Price chosen, not highly customizable. What about the time frame of the trade? Well, this trade, we can get into one for a limit order can be placed and canceled for really any time frame as long as it hasn't filled. Not true with selling puts. We can sell a put for 4 days or 11 days or 18 days or 25 days. And if I wanted one, if I really wanted one for 21 days, doesn't matter. It's not available. Now, even if we're okay with the share quantity, we're okay with the price that we've selected, we're okay with the time frame of the trade. Not every stock has options, and not every stock that has options has liquid options that the trader might consider to be tradable. So it's not available for even the idea isn't available on every security. And a final thing that's a huge deal. Final thing that's a huge deal is our limit order trader can just, you know what? Let's say this has happened. Let me do one more thing here. Let me remove this drawing. Let me remove this drawing. There we go. And let's just say that our stock has started moving down, and it's going down faster than the trader's comfortable with. They think, you know what, it just feels icky. I don't want to buy the shares anymore at 150. Limit order trader can just cancel the order. The trader who sold the put has to buy that put back to end the trade, and they'll probably have to pay more money to do that. They may not have to if enough time has gone by, but if the shares are falling in price, puts are getting more expensive, and it could cost them more to get out of this deal, even if they've changed their mind about wanting to have to buy the shares at 150. So is it a strategy that could appeal to some who are really okay trading in round lots at specific price levels on certain securities, getting into a contract and collecting a premium to maybe buy the shares at a lower price? Yeah, that could work. But it's not a flawless strategy. I can't find any flawless strategies. I still haven't stumbled across one yet. So I always try to discuss the pros and the cons before we make the commitment. But today we're going to go make our paper money commitment. Let's go to the 20th of February and sell. I think we're going to be able to get a little bit more money for this, probably because the price has come down a little bit. Let's click on the bid price and sell a contract. And how about we say we're willing to settle for, well, let's leave it at the natural, 107. So just a few pennies wide on that spread. Let's click confirm and send. We're going to sell this put. You know what? Actually, since we've been talking about $1 the whole time, I'm going to say I would even accept $1. Probably going to get more than that, but let's say we're willing to accept as little as $1 for our limit order. Let's sell that 20th of February, 150 put for $1. That obligates us to buy the shares at 150 bucks. And if those shares collapse to zero, that could be a $15,000 loss exposure. It's not very likely. Could happen. Procter & Gamble goes out of business. Anyway, we also have to pay a little commission here that it chips away at the net premium collected. So let's send this order off, and there we go. All right, so we actually filled that at 109. A little bit better fill. Mark says, you just made a market maker very happy. Yeah, I made a paper money market maker very happy, Mark, by saying, I'm going to put in my limit order below current values. Well, it makes it easier to get that order filled, but it's just at the trade-off there is we may have to accept a lower price. In this case, we didn't. We sold at 109. But everybody, thanks for giving me your time today. We've actually accomplished what I set out to do today. I wanted to look at current positions, check out the markets, and then discuss why some traders actually prefer selling puts versus using limit orders to buy stock. There are pros and cons to that approach. I think we've done a fair job of weighing those pros and cons. And then we plan to place an example trade. We'll see how this one goes. It's just going to go into the group here, and we'll follow up on that in future webcasts in future weeks. But I hope you enjoy this discussion. This is what we do on Mondays. So put it in your calendar to join me Mondays if you can. Otherwise, watch the recording. That's fabulous too. But I want you to also be aware of the additional resources you have from Schwab Education, including Trader Talks channel on YouTube. Make sure, if you haven't subscribed to our channel yet, go down, click on the subscribe button. It only takes a second, it doesn't cost anything. But our Trader Talks Schwab Coaching webcast channel is where you can join the live streams, or you can find the playlist for previous webcasts. Now, another thing that you'll want to do is follow your favorite Schwab presenters on social media. You can follow Barb and me on X and on LinkedIn. On X, you go to @BarbArmstrongCS, or you go to @CameronMayCS. So here's my X handle right there. On LinkedIn, you go to linkedin.com/in and then /either Barb Armstrong CS or /Cameron May CS. There's my LinkedIn profile, linkedin.com/in/Cameron May CS. Give me a follow here. If you reply to one of my posts on either platform, I just try to reply right back to you. But guys, thanks for giving me your time today. I really appreciate it. Thanks for all the thumbs up. That's always appreciated as well. 176 people watching the live stream, and I can see 48 have already clicked the thumbs up. That's fabulous. It's a nice little pat on the back to the presenter, but it also gives our video a boost in the YouTube algorithm so more people can find these discussions. All right, everybody have a great day. Go enjoy Liz Ann Live. That's coming up next. I will see you in a future webcast. I have a new one every day of the week, so I'll maybe see you tomorrow. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.